So at some point in your option trading career, you've probably come across the idea of selling options to collect premium. And the most common tool used for it, popularized by tastytrade, is the Iron Condor. Now the idea behind the Iron Condor is pretty straightforward. You're selling an at-the-money straddle to collect that premium, and then you're buying wings to hedge your position so you don't have that unlimited risk exposure. But one of the questions I get asked all of the time is, Sean, where do I buy the wings? In the end of the day, there's so many strikes out there. Which ones do I pick to buy my wings, and why am I doing it? So in this video, I'm going to break that down. I'm going to share with you exactly how I go about picking my wings and why I do it the way I do. And what you'll discover by the end of this video is that the formula I use is really straightforward, extremely simple, and highly effective. Now, just a quick reminder, if you want to learn more about the way that I actually trade the markets, you can trade live with me every single morning on YouTube at 10:30 a.m. Eastern Standard Time. All you have to do is subscribe and hit the notification bell, and you'll receive a message the next time I'm trading live on YouTube, which is probably tomorrow. Now I'm going to share my screen and share with you an optimal and repeatable way to pick your wings for the Iron Condor. So let's say I'm scanning for a trade and I decide that Apple implied volatility is way too expensive. So I come over to the option chain for Apple, and let's say I want to trade about 30 days out. So I'm going to do the March 19th contracts. Now most people would come in here, sell an Iron Condor, and try to put the wings so that the premium they collect looks good to them. But we want to do something a little more systematic, a little more repeatable. So what I like to do when I first come in is I like to price out the at-the-money straddle. So let's sell the at-the-money straddle. And we can see that the at-the-money straddle is going for about $9.30. So here's where things start to get cool. Why is this straddle priced at $9.30? Well, this is actually the implied move by the market. The market is saying that by expiration, it expects Apple to be up or down $9.30. The reason I call this the market's expected move for Apple is because the market tries to give a fair bet. So given all the information the market has, this is the move expected to happen. But what we're doing here is we're coming in and saying that this move, this implied move here, is too expensive and we want to sell it. But we want to buy those wings to hedge our position so that if there is a big blowout move to the up or downside, we are going to be able to avoid taking on those massive losses. So since we think the market implied move is expensive, we want to be selling at least that $9 to $10 range move. We want to be selling that. So what I'm going to do is I am going to determine where I put my wings based on that move size. So let's see what that looks like. For simplicity's sake, we will say that this is a $10 straddle. Now that I know the price of the straddle, I'm going to come to the at-the-money strike, which is 130. I'm going to sell an Iron Condor. And I'm going to put my body strikes at the money. So 130 and 130. And now for my wings, I'm going to put them one straddle price up or down from my at-the-money strike. So let's go ahead and analyze this trade. And here we have it. So what you can see here is our Iron Condor. Now what you can see off the bat is that it looks pretty even. The risk reward looks pretty good. The wings are balanced. But what is most important is that our break-evens are very close to the market implied move. Remember, when we look to put on a trade like this, we are saying that the move implied by the market is expensive, and we want to collect that variance risk premium. So it makes sense that the move we sell should be very close to the market implied move. So once again, you want to sell the at the money and then buy your wings one straddle price up or down from the at the money strikes. And that is how you're going to go about structuring your Iron Condors in a systematic and logical manner. So those are the basics, but we have one more question that we need to answer, which is what if you have more confidence in your position and want to put your wings further away from your at the money strike? What do you do then? Well, my advice to you is to always think in terms of straddle prices, right? How many straddle prices away do I want to put my wings? If I have normal level confidence, I'll put them one straddle price away. But if I have a higher level of confidence, then maybe I'll put them 2 or even 3 straddle prices away. Remember, the wings are there as a safety net. It is the reinsurance to the insurance that you're providing to the market. You never want them to become the primary focus of your trade. They are simply there in the background in case things go wrong. If you're still feeling uncertain about where to put the wings for your Iron Condor, leave me a comment below with your question and I'll be happy to get back to you. We need to really understand how we're picking these wings so that as we go forward, we're not giving up too much premium by putting our wings too close or putting them so far away that we might as well not have them at all. This is a systematic way to do it moving forward that guarantees you have the right structure on for the view you're trying to express. We'll see you in the next video.